Thanks very much for doing this.
Hi, James. Thanks for having me.
I think you've given me some slides. So I think what we'll do is just turn the pages for a while you kind of introduce what Invesco Asia is and how it works, please.
Yeah, that sounds brilliant. So maybe I will start quickly introducing myself and the team, and then I will move on to talk about the basic of the trust, and then finish it with the reasons why investors should consider investing in Asia now. So my name is Fiona Yang. I have worked in the finance industry for over a decade. My career at Invesco started with being a China analyst, and then later on taking up coverage across the region. And I'm currently the fund manager of the Invesco Asia Trust, as well as the Invesco Asia Income Fund. And I manage the Asia Trust together with Ian Hargreave, who heads the team. We have 9 investment professionals in the team who look at not just Asia, but also the broader emerging market. And actually in February this year, I relocated from our Henley office, where everyone else in my team sits, to the Singapore office. And being here in Singapore has given me the opportunity to be on the ground, being the live trading hours, and gathering more local Asian knowledge and share with the team in a timely fashion. And just moving on to the next slide, just introducing some of the basics of the trust. So the Invesco Asia Trust invests in a portfolio of companies in the fast-growing Asian economies. The fund has managed to deliver outstanding performance over the past decade. As shown on this chart, this is a performance over the past 10 years. The trust NAV has grown by over 300%, outperforming the benchmark by approximately 90 percentage points. And the annualized return of NAV is approximately 12%. I guess the natural question for the audience to ask is how we get there. And the next few slides show the trust investment objectives and principles. Maybe just one more. Yes. So we do have a long-term investment horizon. We target to significantly outperform the market over 3 to 5 years rolling period. And on average, if you look at the turnover of the trust, is approximately 30%. And for each individual stock we buy, because the portfolio is a combination of all the stocks we own, we do target a double-digit annualized return. Such bottom-up approach allows us to achieve the 12% annualized NAV return shown at the previous slide over the past decade at the portfolio level. On the principle of investing, we are contrarian investors. We try to find ideas in areas of the market that other investors might not like. We also care deeply about valuation, because we find it difficult to justify valuation of companies which are burning cash with no plan to generate positive free cash flow. And we want to find comfort on downside protection, so we want to buy companies with relatively strong balance sheet. Another point is that bottom-up investigation of the company is critical to help us understand where we are different from the market, how we define that we are contrarian. And the next chart in the slide shows in motion how our typical investment life cycle looks like. And so companies tend to have a upward trending fair value band, as shown in the chart, the white light color band. However, with the noise in the market and swings in investor sentiment, share price would deviate from companies' fair value. That's when we can come in place and try to buy shares when it is below estimate of the company's fair value, as shown at the green dots. And the expected return is in excess of our target of over 10% per annum. And then we, as the share price rises, we continue to revisit the estimation of fair value, and we will sell the companies when they are trading at close to the fair value estimation. Just moving on to my to the characteristic of the Invesco Asia Trust. As you can see, the current price to book ratio is 1.4 times, and the forward price to earnings ratio is 11 times, and the forward dividend yield is 2.8 times. The valuation as compared to the world index and compared to our benchmark Asia ex Japan index is all at a more attractive level, and the forward dividend yield is higher as well. And maybe we can just skip the slide to, this is just some key facts of the Asia Trust. I just want to highlight here the dividend yield. The board has introduced a new dividend policy. So right now we basically pay 4% of the company's NAV to our shareholder in semi-annual semi-annual, and then the dividend yield, because of the discount that the trust is trading at, is currently at 4.6%, pretty attractive in the Asia context. And just moving on to the last bit I want to cover is why should investors consider investing in Asia now? So I see three reasons behind that. The first is the growth that the region offers. The second is the valuation, and lastly, the policy support. So Asia does offer prospects for both cyclical as well as structural growth. Economic activity is gradually returning to normal, and we have yet to see a post-COVID recovery in some industries and countries. And many countries in Asia are still at an earlier stage in their economic cycles as compared to the Western world. Rising incomes and consumer penetration are tailwinds to structural demand. And on the attractive valuation point, this chart actually shows pretty well. It is now the Asian market has derated over the last 12 months and is now trading below historical average at a more reasonable 1.6 times price to book ratio and a forward PE around 13 times. This valuation level has historically been a good entry point for future returns. So as this chart suggested, if history were to repeat itself, if you invest now in the Asia ex Japan region, you should be able to get 8.7% 5-year compounded annual return. And also just to point out, Asia is actually trading at approximately 35% valuation discount to global equities, again putting Asia at a more attractive position as compared to global equities. And on my last point on the policy support, Asian central banks have adopted a more normalized monetary as well as a fiscal policy throughout COVID. So they have less inflationary pressure and the policy tightening risk at the current point. All this put together, I do think investors should consider investing in Asia now. That's my presentation. I will pass the time back to James.
Brilliant. Okay. Narrates the price to book through time again. Yeah, that's quite a good chart actually. What I did, let's have a look. There we are. So I just pulled out here. This is the geographic breakdown of the fund. So obviously you're giving us figures for the whole of Asia, but within that, are there markets that look some markets look better than others?
So the fund is definitely has changed its position quite meaningfully over the past 12 to 18 months. So the first one I want to highlight is we do find a lot more exciting opportunities in China. We did increase the portfolio weighting towards China by almost 10 percentage points over the past 12 to 18 months. From a significant underweight position last year to currently a slight overweight. Investing in China now is probably a bit controversial, but it's a true reflection of our contrarian investment style. Market concerns on ADR delisting, COVID lockdown, and real estate sector turmoil are well understood by investors. The key question for us is how much of this is already in the price. The valuation of China's equity market is now near the bottom of its long-term historical range. And on a 2 to 3 year view, I guess it's easier to get comfort that China will learn to live with COVID. And I actually come from China, and I do want to visit my family at some point, but just given how tight the COVID constraint is, I haven't really met them for the past 3 years. And if we look at as and when lockdowns are lifted, we can be fairly confident that a policy response is coming, likely focused on consumption and infrastructure, and the market will be very quick to respond to that. And the other overweight that we have in the region is Indonesia. So we do see a lot of similarity of the Indonesian market with its Indian peer. Indonesia has very low credit penetration, and its credit growth rate has been subdued for the past decade. So that's an area with a very good demographic setup. We just feel very excited about the structural opportunity. And if you talk about the near-term commodity upcycle, is beneficiary for Indonesia, which is a commodity exporter. That's why we did have an overweight position in Indonesia and quite a few exciting single stocks holdings in Indonesia.
Oh, okay. In China, are you buying the kind of domestic A shares, or are you buying sort of the things that's in Hong Kong?
We do both. We are not really constrained with regard to where we invest. It's really about our bottom-up stock picking. So in China A shares, we do own quite a few names, like some of the home appliances companies. And that's, I guess, where my skill set comes in, because for most of the Asia companies, the reporting is in Mandarin and the communication with management would be in Mandarin. And I'm a native Mandarin speaker, probably better than my English. And that definitely helped to look into the details of the Chinese company's financial statement and help us to get confidence with the company's fundamentals.
Cool, okay. One of the things that I think people who look to China and being put off by is the stories about things like Evergrande, the sort of highly leveraged property companies, and how that's going to be managed. Have you got any exposure to areas like that, given your kind of contrarian stance?
Yes, indeed, we are well spotted. So there's a lot of headline news on whether, this is China's Lehman moment with the Evergrande situation going on. And the short answer is no, because this is actually a self-inflicted policy resulting in the contraction of the property developers' balance sheet, as well as the stagnant pricing in the property market. Maybe the government has taken the policy a bit too far, to the stage that there's so much negative headline news, including recently the mortgage payment suspension. But I do believe the government has many toolkits to be adopted to address these issues. It's just a matter of when they're going to do that and whether they're going to do that, because ultimately they still want to maintain a very healthy sort of property market development in China. And they do not want to encourage housing speculation, which it did happen at some point in the past. And a lot of the private developers' balance sheet is very leveraged, and they do take on a lot of off-balance sheet risk. So all these policies are trying to manage or discourage all this misbehavior among private developers. And now, I guess how I get comfort with there's not going to be a Lehman moment is also on the household balance sheet side, is in a much healthier position as compared to in the US prior to the subprime crisis. And also there's not a lot of subprime loan around in China, and all these complicated financial derivatives products like what we have seen in the Lehman crisis is not prevalent in China at all. And with regard to exposure to the sector, we, being contrarian, we did take a position in one of the state-owned real estate developer. The investment thesis is really, as the private developers face challenges to buy land, to raise financing, or to gain trust among buyers, the state-owned real estate developers should get market share because they have easy access to the financing market. Their interest rate on their loans are very cheap, and they do have very strong brand equity, so that consumers actually trust that their flats will get delivered by this state-owned real estate developers. So in the long run, we just feel comfortable owning such stocks. And if you look at their valuation, they actually get penalized together with all the other property developers, which is unjustified. Yeah, so we do have some position there, and we are closely monitoring the entire sector's development.
Okay, thank you. If we think about India, what's your view on sort of valuations there at the moment?
Yeah, so on India, we are actually structurally bullish on India for many good reasons. And it's just, so what happened is, if we look 18 months or actually longer, 24 months back, at the onset of COVID, we took the opportunity to significantly increase our weighting in India because of the COVID sell-down. We just feel it was overdone. And then a lot of the portfolio holdings in India have done really well over the past, over the next 1.5 years, to the point that valuation has become quite extreme in India. And look at both the PB, price to book value, as well as price to earnings ratio. The market is just trading way above its historical average. That's when the point we came to use India as a funding source to buy some of the other regions like China and Indonesia. So as I mentioned earlier, we do care about valuation, even if we are long-term bull in India and confident on the country's economic development. With the valuation being relatively expensive, we just find it difficult to justify holding on to a lot of our portfolio holdings in India. Okay,
thank you. So in the kind of big picture between India and China, one of the angles people keep bringing up is this thing about demographics, and that India's population is still growing, whereas China is starting to stall and aging quite rapidly. How do you think that's going to play out in terms of the two economies?
Yeah, so it's definitely a good observation, and there's a vast geographical coverage within Asia, and then there's different stages of economic development across Asia. And India is definitely on the side of a country with more favorable demographics. It also as I mentioned earlier, with its favorable demographic in India, we are very confident on the country's long-term growth prospect. But I guess right now, the situation, it is a net importer of commodity, especially oil, with the rising commodity prices. We just feel the current account deficit situation in India might not be favorable to the country's development in the near term. That's why we temporarily have an underweight position in India. And then on China, the demographic structure is definitely working in the reverse direction. Population is rapidly aging because of the one-child policy, which I am a single child myself, introduced many years ago. And even now, when the government tried to encourage families to have 2 or 3 children, people don't really want that because of expensive education, because of the expensive housing conditions. So what we do as investors, we try to focus on stocks that could benefit from this, say, increasing need for healthcare among the elderly. We did invest in innovative drug company in China, which will continue to push out pipeline to address this aging population issues. And we also focus on stocks which could benefit from rising income of the general household. Although, you know, the people are aging, but then their income are rising at the same time. For instance, we invest in cosmetic companies in the region that could benefit from rising purchasing power of the households, and the women want to become more beautiful. They do invest more into themselves. And so those are the different, we're coming from different angles and try to not just look at the top-down themes, but follow up stock selection as well.
Cool, okay. Here's the top 10 holdings. I suppose actually these are maybe common to many other funds, I suppose, but maybe it might be interesting just to, why do you think that Taiwan Semiconductor deserves to be sort of the biggest position in the portfolio?
Yeah, so TSMC has historically been one of the company in Asia that has proven itself in terms of its technology leadership. So if we look at 10, 20 years back, TSMC is actually significantly lagging behind its international peers in terms of its technology. But over time, it has collaborated with its customers closely, and it has invested a significant amount of money into R&D as well as capital expenditure to basically improve the way that it designs as well as manufacturing its semiconductor. Now it's #1 position in the foundry business, way ahead of its second peer with Samsung Electronics. It's our #2 holding. TSMC has absolute leadership in terms of the cost structure for foundry business, and this leadership position is in no way can be competed away. So that's where we just feel comfortable with its leadership position and its end industry. The end demand is constantly growing semification of the entire sort of world, because everything from cloud, from the computer that we're using now to try to talk to all the audience is all reliant on TSMC's product. Maybe in the near term, there could be some cyclical headwind given this global recession risk that everyone is talking about. But then again, given our sort of contrarian investment framework, we actually feel very comfortable to own more TSMC rather than less.
Okay. These are all fairly big companies. What's the sort of market cap range of stocks within the portfolio?
Yeah, so we tend to we focus on the liquidity or the daily trading volume of the stocks we own in the portfolio. We don't want to be coming to the position of having a lot of illiquid stocks and being difficult to sell them if we do want to. So the fund do have majority, 2/3 of its more than 2/3 of its investment in the big cap, and then have about a quarter of them in the mid cap, and then the remainder in the small cap. So it's relatively liquid holdings that we have.
You take us through the process of how you go about identifying a potential new investment, and then what sort of due diligence you do before you actually do start buying it, please.
Yeah, so we have we do have an investment process that we introduce for the entire team. So firstly, we will do the screening process to identify interesting ideas, and then we will produce something called phase 1 of the investment case, where it's a relatively short of a 1 to 2 pager introducing the stock to everyone and why the market doesn't like it, why the contrarian, how can we be different from the market. And then we will move on to do a lot more extensive bottom-up work, including talking to sell-side analysts, talking to the company management, talking to some of their peers, as well as companies in the supply chain or their customers, trying to find out more about the company. And then we will try to put together a proprietary model on the company to estimate the fair value of the business. If you recall the chart I showed earlier, the fair value estimation for our investment case is very important. So through modeling, we do come to approximation of the fair value, and then we will put together a phase 2 investment case, which is much more comprehensive. We would include a lot more analysis and then elaborate the investment case. Then we move on to a team challenge session through our team meeting. The one who initiated the idea would put forward, present the idea to the whole team. And because everyone in the team is a generalist, they would understand the market, the sector, or the country this company operates in. They would challenge the idea owner from different angles, and then we will, the idea owner will probably go away to come up with answers to those questions and justify whether the investment case still holds. And if everything is a valid investment case, fund manager would decide to invest in this for their individual funds. So that's roughly how it works. And then this is the first step of the life cycle of the investment case, as shown at the green dot. And then later on, we will do a lot more follow-up work and continue to reassess the fair value with of the company with updated, say, company reporting, or more information that we gathered from, say, industry experts or some other sources, or just the global macro landscape could have changed. So a lot of the assumptions need to be updated. So it's a continuation of the work until we fully exit the stock. And oftentimes, even if we fully exit the stock, we will continue to monitor it because it's something that we are familiar with, and we wouldn't exclude it from our owning it again.
How important is it to actually meet these companies? Do you make a point of meeting them before you invest in them?
So yeah, we do meet the companies in Asia all the time. The data, the latest data that we probably met over 700 companies last year, despite the ongoing COVID situation, because meeting the company give us a sense of how confident that they are with their guidance that they have given to the market, and meeting some of the peers of these companies also give us some more credibility of whatever the company A have said. And generally meeting more companies give us a sense of where the economic direction of the entire country is going. So we do value the time that we have speaking with the company. And the other thing I guess I want to mention is we do play a part in some of the ESG element of the companies, and the way that we try to influence their ESG practices is through actively engaging with senior management, CEO, CFO, the chairman of the board, and etc. So we do highly value the time that we have with company management.
Within that sort of ESG area, what's sort of more, I suppose, which thing do you end up sort of engaging most with? Is it governance side of things, or is it social, or is it environmental?
It really depends on the individual case. We do first assess the materiality of the ESG issues for the companies, and we do utilize a lot of internal resources. So Invesco has a quantitative tool called ESG Intel, which will gathers a lot of data across the world and put together to analyze give a score to companies E and S and G. And then we also have global ESG team. We leverage on this team's expertise, try to get the best ESG standard and try to share that with our portfolio companies. And maybe it just makes sense to give you some examples on different scenarios. I guess on the E side, we have written and spoken to Astra International Senior Management. It's one of our top 10 holdings with regard to their emission reduction target, which has led to the company's decision to increase their adoption with renewable energy and have an emission reduction target for 2030. And on the social side, our top holding again, JD.com, we engaged extensively with JD in the past to improve their labor relationship with its in-house delivery fleet drivers. And another holding, not in the top 10, but Mahindra is a tractor and auto conglomerate in India is a good example that we played a part in the company's governance framework. We help the company's decision to refrain from further malinvestment in its overseas subsidiaries. And as a result, the company's conglomerate discount has narrowed significantly over the investment time frame. So these are just some of the different examples that we do engage across different topics on ESG. It really depends on the individual cases that we look
at. How does gearing work within the fund? Assuming you do use it, how do you decide how much gearing to take on?
Yeah, so we do use gearing, and at my outlook, I was saying we have become increasingly positive on the regional outlook. So if you look at the fund's gearing, at the same time last year, we have about 3 to 4% net cash in the trust because valuation was much higher, and optimism on the regional outlook is quite high. And over the past 12 months, with the region being derated, we have been deploying this cash and raising the trust gearing to invest into the market. So now the gearing is stands around 2%. Asian market valuation, as I pointed out earlier, is 1.6 times price to book ratio. And with regard to how we decide the gearing, the other element apart from this valuation, we also look at the earnings revision momentum, which right now is still it has bottomed out, but it still have a negative revision outlook. So when we want to raise the net gearing even further, that's when we are probably just waiting for the earnings revision momentum to get better from here on.
Great, okay, that makes sense. In terms of the yield then, so this is now, as you said, 4% of NAV. How much of that is actually covered by revenue? Because I think I was trying to find the pet slide, but I can't see what it is. But I think you said there is a decent yield in the portfolio underneath. Is that true?
Yeah, just go up one more page.
Here we go. Yeah. There we go. That one. Yes.
Yeah. So the majority of the dividend will be coming from the income that we derive from portfolio companies, but then the rest will come from the reserve of the company. But it doesn't, I guess I just want to emphasize this policy introduced by the board is to ensure our shareholders get a consistent stream of income. But at the same time, the board emphasized that it doesn't really constrain how the fund managers want to run the fund. And in general, we do find in Asia that companies do have a very strong balance sheet, and especially the ones we hold in the portfolio, and the cash flow yield, as you can see, is very strong in the portfolio, and a lot of the management across Asia do voice their intention to raise the dividend payment ratio. So it's very likely that the forward dividend yield could look better and support the majority of the distribution of the trust.
Okay. What was the effect of the rising energy prices on the fund?
Yeah, so on the rising energy prices, I guess the most obvious one is we do prefer energy and commodity export countries with our covered geographies. Previously, we have talked about Indonesia, which is the net commodity exporter, and Australia is another country we have added more exposure to recently. And on the negative side, I guess we have a more cautious view on India in the near term, given its heavy reliance on imported energy, and it would negatively impact consumers' discretionary spending because they are spending more money on fuel. And on the single stock level, we invested in a company called Worley. It is a global company headquartered in Australia, which provides engineering, procurement, and construction services to the energy and chemical sectors. So its customers did scale back capital expenditure plans after outbreak of COVID and very low oil price, leading to sharp contraction of Worley's revenue and profit margins. As a contrarian investor, we started doing a lot of work on Worley when oil price is still relatively low and just started to turn up. And I guess the structural view on Worley is actually it want to be a ESG transformer. They want to support their customers towards producing more green energy, and that's the angle that can support the company's structural growth. So as you can see on the impact of rising energy price is both a top-down sort of portfolio allocation decision, as well as we want to take advantage of that and try to explore more bottom-up single stock ideas as well.
Okay. If we talk a bit more about inflation, because obviously that's clearly a problem here, clearly a problem in the US. To what I suppose, especially kind of like food price inflation, fertilizer costs, that sort of thing. How's that affecting the region?
So yeah, so definitely inflation has a negative impact on the region, but inflation across Asia, I just want to point out, is a much more manageable position as compared to the developed market peers. This is purely because the Asian central banks have adopted a much more conventional monetary policy during the COVID period. We have never really seen, aggressive printing of money and giving to everyone in their pocket. As a result, there's not much excess liquidity to be absorbed in the system. So a lot of this inflation pressure, as you mentioned earlier, is probably in the food, in the fertilizer, and in the raw material space. And in the case of China, the central bank actually has more room to further cut rates rather than increasing rates, purely because they haven't done much easing during COVID, and the country is also facing significantly less inflationary pressure. And at this point, we again just think the market has probably overreacted to the inflationary risk, especially across Asia. And we started to invest some staples company that could enjoy a nice rebounding margin and profitability once the commodity prices start to trend down. So we see it more as an opportunity rather as a risk across Asia that will significantly impact the entire region's outlook.
One of the things that was kind of cited here as a reason for inflation was the problems in supply chains, and that was kind of linked to recently to the lockdowns in China with the COVID. Do you think that's definitely come to an end now?
I don't. So maybe just on the supply chain issue first, it is again less of an issue in Asia because that is the region that supplies the rest of the world. So the question here for most of our portfolio companies, actually these exporters, they get negatively impacted from the transportation bottlenecks. The product that they produce can't be shipped on time to their customers. And then on the case of COVID lockdown in China, it is not clear exactly when the country will move away from this zero COVID policy. But I guess on a 2 to 3 years time horizon, and that's where our investment framework time frame is more like 3 to 5 years. So on that time frame, we feel relatively comfortable that China will be like the rest of the world, comfortably live with COVID, either with development of more vaccinations or just the maturity of some of these COVID drugs can be introduced to the people. And once those come into place, I just feel there's no reason for China to continue its lockdown.
Okay. Just one last question here that we should cover is the technology one. So actually, again, if we look at the portfolio, there's quite a lot in technology there. What was the benefit to these companies of the increase of like working from home and stuff like that we had in COVID? Because we definitely saw a kind of boost to digital innovation here in the UK and also in the US. Was the same true in Asia?
Yeah, so I actually want to highlight that the trust is probably significantly more overweight technology a year ago as compared to now. So even in the top 10 holding, it might look like we still have quite a lot of technology holding, but then across the fund, we have cut down the exposure quite meaningfully for the reasons, structurally we're still bullish, but the near term there's a lot of cyclical pressure because exactly as you said, during COVID time, a lot of the technology stocks have benefited from working from home, from rising demand for their products, and post-COVID, as life resume normal, the demand for these products might not be as high as before. So we are, and the other element is actually the global recessionary risk. People tend to spend less, say cloud or data centers tend to spend a bit less as compared to they were planning. And with the inventory as well as the production capacity built up during the COVID period, we might see this period of inventory adjustment among technology companies. That's why we actually decided across the fund to bring down technology as well as the Taiwan weighting, where Taiwan is predominantly technology stocks. We bring Taiwan as well as the technology sector to underweight position. But then digital innovation as a theme across Asia is definitely a very exciting area to watch. And I want to highlight not just the technology hardware, but some of the internet companies' development. They are as innovative and in some cases even more advanced in their developed market peers. For instance, mobile payment is highly prevalent across Asia, and in Singapore, where I sit now, it uses various payment apps developed by traditional banks as well as the new mobile payment players. And e-commerce penetration is one of the highest in countries like China and Korea. And TikTok, I'm sure a short video app a lot of younger people use, has gone more viral than many of its developed market peers. And another area that the fund always and always have a lot of position in is computer gaming companies. So Tencent is one of them, and another holding used to be on the top 10 list, NetEase. They transferred the ways computer games were played from console PC to mobile, and the monetization format has been completely changed by them from pay to play, i.e. you pay and buy a console game or a CD to play, to free to play. You just download the game and then you spend your money on buying avatars or other in-game items. So our portfolio companies, they have brought many exciting games to the global market recently. And this morning, I was just having the chance to listen to a call hosted by NetEase CFO to talk about the confidence that the company had to generate 1/3 of its gaming revenue from the global market, given how successful some of the games they have brought to the international stage in recent quarters. So all of these are very exciting digital innovation across Asia, and an area that we closely monitor and want to position the fund towards.
And how do you value something like that? When you're valuing a stock, you're sort of talking about what the right valuation is. Is it all done on this sort of discounted cash flow basis, or are you looking at it valued relative to peers or relative to the market? So I mean, for a technology stock that tends to trade in a higher rating, would you say they're okay because they're technology and we'll pay a bit more for them?
Yeah, so we focus on valuation, but doesn't mean we are a value fund. So we do have a diversified portfolio that includes many of the technology or internet stocks, a high growth company we talked about earlier. And for us, the valuation methodology, we really use different methods. So price to earnings ratio, price to book ratio, as well as free cash flow, discounted free cash flow are all considered when we put together our model. We try to use two valuation methodologies to cross-check the numbers to see whether this target price or fair value estimation that we have actually makes sense. So all these companies that I mentioned, the technology company I mentioned, actually generate free cash cash flow yield, decent free cash flow yield. We try to stay away from other companies which do not generate cash, do not generate anything in our view, and which are extremely difficult to value and extremely sensitive to some of the assumption that you have for 10 years later, what sort of unit economics could be for this business and what sort of volume this business could generate. They're just it's just way too sensitive, and it's not easy to actually come to a reasonable valuation for those high growth and low earnings or no free cash flow companies. So the valuation does play a quite meaningful part in our bottom-up analysis, but doesn't mean that if a company do generate growth, do generate free cash flow and predictable free cash flow, we feel very comfortable coming to a fair value assessment of it.
Okay, thank you. There's a few more things popped up here actually while we've been talking. Actually, maybe one of those we should address. So valuations can swing around quite a lot. Does that increase the turnover within the portfolio?
The general turnover of the portfolio is around 30%. So say if on our average we have 50 to 60 stocks. So that means probably every year we will have 10 new ideas going into the portfolio and 10 old ideas coming out of the portfolio. Don't quote me those exact numbers, but I'm just giving an example of how it usually looks like. And I guess during COVID period, the trust did have a slightly higher turnover as compared to usual. But given our investment framework, the time horizon 3 to 5 years, we try to the turnover is around 30%.
And then an interesting one, I think, given this has been a sort of strange old year in markets, what have been the best performing or the biggest contributors to your performance this year so far?
So best performing.
Well, maybe it's saying the biggest contributors to performance. So
yeah, so one of the stock is called Mingyang Smart Energy. So this is a wind turbine maker in China. I think we have a lot more in the trust before, and now it's not in the top 10 holding anymore. But Mingyang Smart Energy is a wind turbine maker in China. It does have a vertically basically, it produces components of wind turbines, and then they put it together. And they also have wind farms, construction and wind farms under operation. So it's a fully integrated wind company. And we started buying the stock at a time when investors were skeptical on the country's wind installation outlook, because China in the past used to pay a lot of subsidies to wind farms, and the wind turbine companies would enjoy part of that subsidies as well. So there was a rush of installation in China when the subsidy was still around, and then the subsidy has consequently been removed because the grid parity is very close for wind farms in China. So as a result, the company was trading at an extremely cheap valuation as compared to some of their European peers. But structurally, China have this 2060 net zero target, and in order to achieve that, wind farms and wind installation is just very critical alongside with other renewable energy, because coal is still the predominant energy source in China. So with that bigger picture backdrop and our understanding of the strength of the company, we started investing in Mingyang Smart Energy, and it has consequently generated very good return. The growth has been, the top line growth as well as margin outlook of the company has been pretty phenomenal. As a result, it is one of the best contributor to the fund performance over not just 1 year, probably over 2 years. Great, okay.
Well, we've covered an awful lot of ground, Fiona. Thanks very much for answering all the questions. We actually run out of time, remarkably, but it's been very interesting. So we'll get you back in a year or so and see how things are going.
Thank you, James, for having me.
Thank you. So we'll be back next week as usual, talking to Nick Bryn from Public Capital Financials. And as I've been saying for a few weeks now, we've got a long list of people lined up for you, even beyond into October. So keep tuning in. We shall see you next Friday. Thanks very much again. Bye-bye.